Good afternoon. Some people are actually there, which is great. Okay. So, my voice. Good afternoon. There, I get to hear myself. That's the delay. You can see what delay there is. So, how do I sound? Do I sound piercingly loud like that sounded? Let me see if I can adjust the volume. I don't know if it's the cable. I'll just turn this down a little bit. How's that? How's it sound, Paula? Well, I'm in a kind of a bad mood, kind of a good mood. I don't know how to explain it. But I attended a faculty meeting and tried to get my point across. It's really hard when you don't speak the primary language of most of the faculty. But, I mean, I could, but it wouldn't sound intelligible. So I spoke in English and made the case that we shouldn't be changing the curriculum in any way without a careful analysis of the impact of the change. In so many words. I said it in very few words because I was so frustrated. So anyway, the meeting was long, but I hung in there. We got very close. The people who favored my position lost, but by one vote. And I just found out one professor who was going to vote for the position couldn't click on the link to enter to vote, and then he got disrupted and he couldn't continue in the meeting. So these things happen. It's very discouraging, but I guess there's always going to be another vote and another day and another opportunity, so I have to be positive and hang in there. Right? So someone asked me, why do I care so much? It's a good question. But you have to care. You have to care. You have to give a crap about things sometimes that you do, right? All right, so so here we are. Let's see who gets in here. Let's talk in the next few minutes while people enter. We'll wait till about 10 come, or I'll just start in a few minutes. The test. I will give you the test tonight at 6. Some people asked for it early, which is fine with me. I don't care. I'll give it to you at 6. And then presumably you will work on it till, did I say till 3 p.m.? Remind me what I said. I should have written it down, but if you saw my desk full of a bunch of papers, it must be somewhere here. But I haven't had a chance to collate all my papers and my notes. So if I give you the test tonight, so test 3 is I will give it Friday at 6 p.m. until Saturday at 3 p.m. Is that okay with everybody? So you have overnight, gonna have fun working on that. And as usual, handwritten answers. You might want to do stuff in Excel. So how am I gonna grade that? Just limit the things that you do in Excel. Make sure you include formulas. If you use Excel, I'll put it in the instructions. If using Excel, provide titles with formula in them. Or just, if you cut and pasted, make sure you include it. No, because how are you going to do that? Because I want you handwritten. Okay, so I want handwritten assignment responses. If you use Excel in some parts, provide the formulas. So otherwise I can't grade it, right? Okay? So handwritten responses, if using Excel in some parts, provide titles with the formulas that are used in each column, if that makes sense. So, and thank you. I don't know what I was going to say. Some comments. Thank you, Juan. Okay, I can't talk about this stuff too much because it's too emotional. We're never going to get through the class. Okay, so let me continue. Okay, where did we leave off? So I promised you I would talk more about this. I promised you I would talk more about Markowitz portfolio theory. I have to check the documents that I gave you to make sure that I actually got into this very deep. Let me double check that. And I apologize for not getting your second test back to you. There's just no way. It's so difficult, and I have so much work. But what I'll do is I'll send you the clave. I'm going to write it down. I'm going to send you the clave for the test so you have them before the final, right? And the final, to clarify, the final will be on the 14th, and it has to be online, right? I'm going to do the final exam. It will be online. And I said I would put it up. Did I say 9 a.m.? You guys can correct me. 9 a.m. to 12 p.m. And the reason is that's sort of where it's scheduled in the exam schedule. I promise you it's going to be easy. It's going to touch each topic. It was so easy. I made it so easy last year. But if you know it, and you have to know the topics, but you don't have to be an expert. And I'll just have a few questions touching all the topics, okay? And it shouldn't take you 3 hours, but I'm going to leave the 3-hour time. So it's just to record you. I'm going to put the camera on, so you have to make sure you use a computer with a camera. And we're going to record you, so everyone is, and we're all in the level playing field, right? Everyone is going to be monitored for the final exam. And it's going to touch all the topics. It will be, oh, I didn't put the date. I got to put the date down. This is going to be on Friday, May 14. Okay, so I have to fix the viewer. Sorry, I'm going to have to move this around a little bit. All right, so how are you guys doing with the review of the materials I gave you so far? Some people say they're behind. I'm going to see, I want to check what I sent you. Okay, so I sent you everything, didn't I? So let's see. Okay, and you have answers for everything. So I need to get, let's see where we get today. But I said I would test you up to last class. So let me just talk a little bit and then we can do some review problems together. If you've had a chance to attempt the review problems, you can let me know which ones you'd like me to do. I'm just going through. We got to do Cap M too. Okay. Okay, so what's happening here? You guys can write any comments in the chat. So what's happening here is we are going to observe the risk and return trade-off for a portfolio. So a portfolio will contain many risky assets. And we begin with 2, just so you can visualize things, okay? So you're going to visualize here these equations. This is the expected return, which is on the vertical axis, and this is the risk, measure of risk or standard deviation on the horizontal axis. And that's the drawing. Oh, so marked up, but this was the conclusion of the drawing. So what do we have here? I should probably clean that. I'm going to clean it. I'm going to do this again. So just to point out, I asked you to verify. What I meant was work with the numbers in the table here and see what's been happening. So what happens is we change the weights. Now this one here will have more of Y and less of X, and we discussed how Y is the more risky asset, right? So Y is more risky. Y is with a standard deviation of 10%. So this is the more risky, higher return asset. So more of that will make the portfolio more risky. So this is the one with more risk, portfolio 1, and closer to Y. And on the other hand, the third one, well, let's see, 1. Let's see where 1 is. Oh, I erased it. Okay. So where would that be? 75% Y is portfolio 1 and 25% set. And if you put them into those formulas over here, okay, you put them into those formulas there, then you see the expected return is 18.6. And that's the same for whatever the correlation is. So let's see. The expected return is 18.6. So that puts us here, you see. Now these are the different cases. This is the case with correlation perfectly negative. So that's perfect diversification, or whatever, ability to completely diversify risk away. And then this one is the one with correlation equal to 0. And this one would be the one here with correlation equal to 1. Okay, so right across here. So it's the same. All I've done is varied the correlation from here to here to here. Okay, so I will, Tanya, we'll do that. We'll look at 5.8. And then similar, you can check, you can verify each of these, and verifying again, putting into the calculator, for number 2, it's 50%, 50-50 of each. So you'd put 50% of each in here, and then here as well, 50% squared, or 0.5 squared, 0.5 squared, and then you put them in here, 0.5 times 0.5, and then you put the correlations, these are the standard deviations here. So just to know what you're doing, and then you vary the correlation. So for 50-50 so 50% invested in asset Y and 50% in X, your expected return will be 17.2, and then these are the differences, right? $17.2. So 17.2 is here, and this would be the one here for for rho equals -1, or the correlation is perfectly negatively 1. And then this one would be the one for where the correlation is 0. So this is 5.16, you see. And then the last one will be 5.72. It's over, if I go across, this is considered to be 5.72. And you can plot all these things. You can do this with Excel if you want to. You don't have to. You can do it by hand too. All right? Any more questions about what this is? So then we plot all the possible relationships, all possible portfolios, considering putting more and more of the risky asset Y in the portfolio. And we do that by putting a higher percentage weight. Remember, the weights have to sum to 1. Okay, so all the weights here sum to 1. Does everybody understand this idea of what I'm doing here? Did you have a chance to look at it? I just want you to feel confident with this. Okay. And then I just summarize here. In general, you'll always see this pattern, okay? It doesn't matter what assets you have. I didn't put numbers on here, but you could calculate. The pattern will be the same. In general, if correlation is -1, you'll see these list of possibilities, and the efficient set starts here, right? Because here is better than any of these. You get both a higher return and a lower risk or lower standard deviation. So this one is better than all those below. The rest involve risk preference, risk tolerance, and trade-off, the trade-off between benefit and risk. Or, yeah, benefit and risk. And then here are all the possible combinations for assets with correlation between -1 and 1. And here, it will always be just a straight line, like a linear combination of the assets if they are perfectly positively correlated. So that's a pattern. And then I talked about this, and I talked about the more than 2 assets. So I just kind of hand wave through this, that this is hard to visualize, right? Because you move from, it's like it's conceptual. I don't know that I can draw it, but this is the drawing taking 2 at a time. And then this is supposed to be all possible assets in some ratio, like they're somehow included in the portfolio. Even if you have like assets, let's say you have assets A, B, C, D, you have a whole bunch, K, and then this is their weight in the portfolio. The weights should all sum to 1. So even though this might be not represented very much, okay, you understand what I'm saying, I hope. Let's say C is really a good one. Whatever they are, they all sum to 1. And all the possible combinations would be here on this, what's called the feasible set. Sorry, the efficient frontier. The feasible set is all of the possible combinations. 2 at a time, 3 at a time, 4 at a time, to all of them. Okay, and I discussed what dominate means. Okay, so an asset that is both higher return and lower risk will dominate everything that's higher return same return and higher risk, and it'll dominate everything that is lower return, same risk, anything in here. So we always look up and to the left for assets that dominate. Then I talked about, so did I talk about short selling? Yes, I briefly talked about short selling. Right, I explained short selling. Does anybody want me to explain short selling again? Or are you good with that? It's kind of important. You okay? So I don't have to do this. So I described here the idea of risk-free lending, which would be in here, buying T-bills, and risk-free borrowing or short selling, which would extend the possibilities along what's called the capital market line, where this line starts here, where you have your risk-free T-bill, which has 5% return and 0 risk, 0 standard deviation, and all the possible linear combination of the market portfolio, that is the tangent portfolio to this line, and the risk-free T-bill. All these possible combinations exist. So you can talk about A, which is where the capital or the investment is half, well, maybe, some portion of the risk-free, some portion, let's say it's 50-50. Let's just write that down. So 50% is invested in the risk-free T-bill, and 50% invested in the market portfolio, this special one here. And then over here, what happens is, give me an example of the weights on B for RF. Give me an example. What would be the weight? So if I wrote XF, what would be the weight on B and XM? Just get you guys thinking. So in this case down here, that one that I already did, XF is 0.5 and XM is 0.5. That's messy, right? Let me do that again. So as a person holding T-bills, you will be lending money, right? So you buy or long, I guess I'll put that word in here. This is called long T-bills, right? You're going to hold them, buy and hold. And that's in contrast to short selling. The idea of short selling brings up this word, the term long, to distinguish between borrowing and holding. So no ideas of what that would be? XF? XM? Guess. Take a guess. It's better if you guess. Skin in the game. It helps you remember the result if you give it a shot and guess. Nope. No one? Well, if this one is 50-50, and this goes beyond M, so here, what would it be here? If this was the one we chose. Let's do that. That'll make more sense. So let's try that. Let's say, what would XF be here for M? Okay, so for M, what would XF be? And what would M be? Come on. Come on, come on, come on. Try. Alrighty, you ready for the answer? Tell me you're ready for the answer, and I'll give you the answer. So I know you're awake and you're going to hear it. Okay, Diego. Good. Nope, that's not correct, but good for guessing. How about right here, XM is 1 and XF is 0. Here, if you're here, this is fully invested in the market portfolio, right? That makes sense? Fully in the market portfolio, no T-bills. So now, this one was 50-50. This one was XM is 1 and XF is 0. So what is this gonna be? What would the weights be for that one? Right, exactly. So what would give me some numbers. So then what would the weights be, Diego, if that's correct? It means that I would short sell and put the proceeds towards the market portfolio. So I'm expanding the possibilities of the market portfolio with leverage, short selling T-bills. That's how the weights would work. Okay? I think it makes sense now that you see it, but that's the idea. So I can expand beyond just the market portfolio. Very good. So now you guys learn that? So I did give some examples with that, and we should look at it together. Can I continue? Any questions? I'll just write it in here in words. Short selling T-bills and using proceeds for an increase the investment in M. A market portfolio. All right, I'm continuing. So that results in here, this is where I left off, and I asked you to work on it because you've seen CAPM before. what happened next is I transcribed the relationship between risk with a beta and the return using expected return on the asset. Notice this is different from the return on the portfolio and the risk of the portfolio. So this is a different curve than this one. So this is called the capital market line. This one is called the security market line. And what you have here is the framework to evaluate all assets, all of them. When I say I mean every asset. So I just plot a few of them. I plot the T-bill here, and I plot the market portfolio here. And I tell you that they are related by, that any return to any asset are related on the line with this equation. And I ask you now, if I didn't ask you last class, what is the slope of this line? I wrote a lot of things. Let me shrink this a bit. I'll shrink it a bit. Okay, so what is the slope of that line? So what do we see here? We see that the beta of the market portfolio is 1. That's really important. Let's put some more things down while you're thinking about it. The beta of the risk-free is 0. Right? Because there's no risk. What does the beta mean again? It's the sensitivity of asset I's returns to the market returns. That's what it is. So the market returns are 1-for-1 sensitive to market returns. The risk-free is not even correlated with the market returns. It's uncorrelated perfectly. It's 0. So there's no sensitivity of T-bill returns to the market portfolio returns. Remembering the market portfolio represents something like the S&P 500, a market index. Or the Dow. Industrial average. Some sort of index that's tracked. Okay, so the question was, what is the slope of this line? No idea? What is the slope? Okay, how many people think that the beta is the slope? Who thinks the beta is the slope? Who thinks the beta is the slope? Anyone? Who thinks the market risk premium is the slope? This is the market risk premium. Remember, we talked about risk premium, but this is the market risk premium. It represents what investors expect in return for investing in the risky assets over and above the riskless assets. Okay, so the market risk premium is the slope. The market risk premium is the slope of this line, and I'll demonstrate for people who are unsure. Let me erase this first though. So, oops. So this is called the market risk premium. And if you look here, and this is treat this as your horizontal, so this would be like your change in X, and this is your change in Y, you see? Now if I go from here on the line to here on the line, so if I go from here on the line to here on the line, I change, oh, that's not what I wanted. Change in X is 1. And the change in Y is right? So that is the slope. That's the slope of the line. And what we're doing is saying that investors that are rational will invest in the risk-free T-bill because that will keep them ahead of inflation. And then to be compensated to take additional risk, they should be compensated for every unit that we've measured of additional risk as measured by the sensitivity of returns on the asset to the market portfolio. They should be compensated the market risk premium. And that's what we say. So now that we know that, we're going to have a discussion about, oh, and I asked you to make these calculations. Hopefully you did it. We can talk about it in a moment. They're very simple, I think. What I want to talk about right now is assets that do not fall on the security market line. What if we have an asset like this one? I'll call it asset K. All securities should be on the security market line. All assets should be on the security market line. All projects that are efficient should be on the security market line. But what about K? What is the adjustment process to put K back on the security market line, or to see how K ends up on the security market line because now it's off a security market line. Well, currently what you see, I'm going to erase this here and here. What we have is that K, for this level of risk, investors expect this level of return. Now, if they aren't getting it with K, they're going to leave K, they're going to sell K, and if this is the level of risk they want, they can create this level by doing what? What can they do to be here? Can someone tell me? I did discuss it, but I want to hear you say it. Clean that up a bit. Well, here you. I want to read you saying it. How does an investor, if they have this level of risk tolerance, they're prepared to take this level of risk, and they currently have K, and they realize, wait a second, I can sell K and do this instead. Well, let's look here. What's there? It's like the CML told us. We can create a portfolio. We can create a portfolio of the market portfolio and short selling T-bills to end up here. So why, with this level of risk, would I just stick with K? K is a lower return. So what's going to happen is not only will one investor realize that, all investors can make these calculations and realize this, and what they'll do is K is currently overvalued. They're going to sell K. And as a result, remembering our very basic formula for calculating, returns, like we had, let me put it like this. Actually, let me write it like this. Let me do that again. So we had a very basic formula like this, right? But what I'm telling you now is, let's say the dividend stayed the same. What will happen is there will be, because people are selling K, there will be downward pressure on the price to get rid of it, right? Because if I'm selling it and you're selling it and somebody else wants to sell it, the price will be bid down. As a result, if the dividends stay the same, this affects the expected return indirectly. So what you're going to see is that the price will fall as people get rid of K to end up here if K is to survive. There's going to be a higher expected return on K. So price is inversely related to return. So this is what we're doing now, right? We're trying to compute the expected returns to assets. And so this is what we're doing now. Did you follow my description? So K under the line, under the security market line, assets are overvalued. What do you think up here? What if there's something over here called J? Tell me about J. So investors with this level of risk only require this level of return here. But they're currently getting this. So what's going to happen? Very good. It's undervalued. Exactly. Undervalued. So what's going to happen? So first of all, if investors just wanted to get out of J and they wanted to create, investors looking at J, they don't want to get out of J. Investors looking at J and understanding, recognizing that this is a abnormally high return for this level of risk, they will want to buy J, right? So they will bid up the price as a result. A lot of investors will realize this, and let's look again at the same sort of analysis I did before. So this is how we think about the price and how it would be affected. So there's going to be the price will be bid up as investors want to buy J. They'll offer higher and higher prices, and in so much that they are indirectly affecting the expected return. So the expected return drops to just here on the line. If it drops below, then again, the argument that I said before, that if investors wanted this level of return for this level of risk, they can create it. In this case, they could buy T-bills and the market portfolio in a combination just for this level of risk. So, oops, I thought I had, okay, so you guys got it? So what do you do if K exists? If K exists and if J exists, what would be the reaction? I explained to you that you would want to, well, if you were holding it, I was talking about selling, and if you didn't hold J, for instance, you would want to buy it. Well, what's going to happen in the long run? In the case of K, the price is too high. So there's going to be a price drop, correct? So identifying that the price is too high, there's going to be a price drop. You should consider short selling. Because when you take a short position, it's with the anticipation that the price is going to, you can do it for different reasons, but one reason is, if you short it, I discussed with you, it's when you borrow an asset. So let's say you found an arrangement with a broker that you could short it. It means that you borrow K, and then you have to return K later. So you borrow K, you sell K, while people are buying it, and then realize when you have to return K to the broker, you're going to get it for really cheap. So if overvalued stock, you should short sell them. And undervalued stock, you should long and hold. You should buy it and hold it because the price is going to go up. Okay. So can you guys tell me if you ever learned that before? Did you learn that before? I don't know how much time I need to spend on it. Last thing I want to say, you guys let me know in the chat if you've seen this discussion before. Okay, so you've seen the discussion before. And so anyone not seen the discussion before? So assets could also have negative betas. Oh, okay, you took investment. So assets have negative betas as well. Can you tell me of an asset that has a negative beta? What does that mean, negative beta? So you have to think about if the returns to the asset, have a negative relationship with market returns. So we talked about some, right? So for instance, gold companies, gold stocks, anything to do with crypto too. Those would have negative betas. Right. Not different, but opposite. Yeah, opposite. I'm not going to say different because if it doesn't move with the returns to the market at all, they could be zero. It could be like have a beta of 0. So negatively correlated assets okay. All right, so what's next? So then I asked you, I just made some statements about the capital market line is just for efficient portfolios. The security market line is for any security and any portfolio, efficient or inefficient. The beta is equal to 0, although the standard deviation of returns for where a beta is 0 can be positive. We'd say the risk is 0. And this would be the case for the risk-free. Notice that I use risk-free without an E in front, right? Because there's no variability in the risk-free return. Okay, so we don't need the E. That shows that there's a randomness. It's always the same. The risk-free rate has no variation. And I just make the note that beta equals 1 is for the market portfolio or other assets with the same level of risk as the market portfolio. And then I asked you to do these. Do you have any questions about this? Do I need to calculate this? Or can you guys do this? I guess I can do this. Let's do this because then we can plot it. We're going to plot these on the security market line. So what did you get for RA? You have to use here the capital asset pricing model to price assets. And pricing assets is the same as determining the risk-adjusted rate of return. So that's going to be RF plus beta I and the market risk premium. In advance, I'm going to write that down because it's much easier. If I say the market risk premium is equal to, oh, and let me erase this too. Let me see if you guys have any questions. No comments? Is going to be the expected return on the asset minus RF, but in this case it's for the market, so we write RM. So then that is going to be 10%. So I'm going to use that every time. So this is going to be 0.1. So I put in 0.04 plus for a beta of 1 point, sorry, not 1 point, 0.8 times 0.1 and so you get 0.12. And then here, same thing, RF plus beta for, oh, this is for A, and this is for beta for B, to be clear. And this 0.1 as well. So that's 0.04 plus 1.2, 0.1. And when you put that together, you get 0.16. So we have now the expected returns and the betas that we can transcribe over here. Now for A, it's going to be 14%, sorry, no, it's going to be 12% and 0.8. So that's going to be over here somewhere. Oh, we made the market portfolio 14, right? So this is 14. If I put the data from this problem in, let's say I put it in blue. So if this is 14%, and then A would be somewhere over here, and you see it has expected return of, we can say that's 12%, or this one was 4. And then this expected return would be in between. This is not a very good scale, isn't it? I have to put it even higher up to put it to scale. Yeah, it's not a good drawing at all for this, for what I'm trying to emulate. But the point is it's below, okay? It's below M. And the beta would be 0.8 and expected return 12. And then B would be over here on the other side. It would be there. So anytime you use the line, you end up on the line, all right? So if you use the line, you end up on the line, B with 1.2 as the beta, and then 16% as the expected return. So that's what happens there. And then what I did was talk about a portfolio created by combining A and B, and you will do you do the weighted average, well, using the weights of 60 and 40, and you end up with a new expected return for the new portfolio. But you can also do the same thing with the betas, the weighted beta. The weighted beta is using the same approach, right? Weighting, pre-weighting the two betas to get this result. This is because these are linear combinations. You end up on the line again. So a portfolio of A and B would also be in between somewhere here. So it would be somewhere here the way that they set it up, because M is 14%, and the one that we got was, so you guys should be able to draw this stuff on a graph. So it's 13.6, so it should be on the line, but closer to A. So I will plot it with the, it would be like here, and that would be P. Questions so far? Okay, so its beta will be less than 1, and expected return will be less than 14%. So if you didn't do it and watch the video again. And the other thing to say to you is that this point should satisfy the line because it falls on the line. And I just demonstrate that with knowing, well, if we get the expected return, we could calculate the beta here. We could solve for the beta here rather than doing the weighted beta. So it's either or. So either you use the weighted calculations or you can use CAPM to get either of them, one from the other. Any questions? So some of you are saying you know this stuff. Is this the first time for anyone? Because it will determine how fast I go. So this was 5.12. Tanya asked me to look at 5.8. That's not what I wanted to do. Well, what happened there? Uh, 5.8. Tanya, you mean the UAIR 5.8? That's going to be the next set of notes. If you're talking about this is solved in the next set of notes that I'm going to get to. All right? So this UAIR case part 2 is for the next set of notes. So if you don't have any questions, I'm going to get into the next set of notes. So I gave you these problems. Any questions about solving any of these problems? This is in 513. So then in 514, I gave you the solution. So everybody's good for this? 514, 515. Which one is the notes? So I have to do 512, okay. So let's talk about, no, I have to do cost of equity. No, we did all this. 512, 15, 14. Cost of equity. Okay, 515. Okay, so we're in the 515 notes now. So no questions. I'm moving to 515. I did it again. I did it again. So here we are. So what's here next is the answer to the 5.8. What we want to do is calculate, given different setting scenarios, the expected return for UAIR. We want to price UAIR's stock. So what I've done here is I've rewritten the capital asset pricing model with lowercase r. Hope that doesn't bother you, but it's just that I guess just to distinguish it from what we were doing before. So what we have here are some extended data on your stock and the market ex post returns for the period 2000, oh I put more in here, 2005 to 2010. So I added some more data. And what we're going to calculate is the beta. Oh, sorry, we're going to calculate the expected return for UAIR first, and then we're going to talk about varying the beta. Okay, so let's do that first. So taking this data, you should have worked through the notes. If you didn't, this is your chance. You can, these are just calculations for historical data, so you can do this very efficiently with your calculators, as we learned. And you can get the returns for the asset and the market returns. You can get the average returns, right? So these are the sample results. And then you can get the variance or the standard deviation to the market returns. And this one, can somebody tell me how I can get this one out of the calculator? So you can put all this into the calculator, where this is your, remember, market is always on the horizontal and the stock is always on the vertical. And you can enter those into your calculator. And though I've written them manually here, you can get all of this out of your calculator efficiently. My question is, you can get this, you can get this, you can get the standard deviation and then square it to get this. We're going to use this formula of the beta because it's less things to calculate than if we use the, if we have to get the correlation first. If we had to get the correlation first, we have to do correlation, MS, and then sigma over sigma m. So this is the alternative formula here that I showed you could get by substituting the correlation into this formula and getting this version of the formula. And these hats are only because you have historical data. You have to put hats on everything. You still with me? You guys are so quiet. All right, so how do I get this one out of my calculator efficiently? I can take the correlation remembering the correlation is just the covariance divided by the two standard deviations. S stands for stock. So this is for UR, stock. So how I can get this is just take the correlation and multiply it by these two. And that's actually what I did to get this formula. Questions about what I'm doing? So if you were to use your calculator exclusively for this, you could get the correlation from your calculator and you can get the standard deviations. So you can use them to compute covariance. So work with that. If you don't have questions, I'm going to continue. And what we're going to do there, I'm going to take what I found. I found that the beta is 1.552. So you can round it to 1.55. And then what we need to be able to estimate using the capital asset pricing model, to be able to estimate, we need the market risk premium, right? Because we've got this. So they gave us, what's given is the question. So do we have this information? We just calculated this, and do we have this information? So you're told in the explanation on document 5.8 that the average T-bill rate is 2.36. Oh no, actually we calculated it using this information. The average T-bill rate is 2.365. So that's just the average of these. And again, you can use your calculator for that. The average market return is 5.11%, which was from here. I guess I could have taken 5.12, but bear with me. Okay, so 5.11%. So the average historical market risk premium for this would be, I use the whole number, or all the decimal places. And so I find what's called the average historical market risk premium. I use that along with the current T-bill rate, because this is what investors are currently looking at. So I'm going to use the current T-bill rate because that's what they're going to earn. And over and above that, they consider the market risk premium as the average historical market risk premium. Okay, so be clear that this RF and this RF are different. Like these come together. So don't separate this RF. It comes as the average historical market risk premium, which was computed using the average risk. So this is more like, I'm going to put a bar on it to remind you this is like different. And then what we found here, we're going to call the required rate of return for UAIR. We haven't done anything particular with the Bahamas case, however. We've just done this for UAIR, using UAIR's previous returns to their stock and the historical information on the T-bills and historical information on market index to represent the market portfolio. So any questions? So what we found out is that UAIR should use this discount rate, 5.27. And they should use it for its projects. As a result of the capital asset pricing model. Any questions? Alternatively, we could have calculated this using all the available data, imagining that the future will be more reflective of the overall average than just this turbulent period. This turbulent period over 2008. So you could think, well, why am I going to use this most recent one? This is so abnormal relative to the regular returns or normal returns that we see in the pattern over time. So just to compare it, let's create a range, several different estimates that we can debate. So here I'm going to calculate the average historical market risk premium over the entire period of data, 1928 to 2010, and I get 7.6%. Using that instead, because it's much higher, results in a higher required rate of return. So this is very different than if you use the last 6 years of the T-bill data. This makes it less likely that the project will be accepted. When these are different, the convention is to use the more current data for a robust or reliable estimate of the cost of equity. Okay? So we're going to stick with the more recent data. Any questions? So that was CAPM. We made two calculations and considered some rationale for making a decision of one over the other. So remember, these numbers come from the charts that I gave you in the risk and return notes before. Those are from, remember when we drew the normal distribution, I had the normal distribution for the risky returns. I also had this 3.7% figure in the tables there. All right. Tanya's speaking for all of you. All right, so what's an alternative? I'm going to use this 5%. We're going to stick with this estimate of 5% using the CAPM. What else could we do? So we have so far two options, but we've chosen so far this option, this alternative. What else? Well, we could use the dividend growth model. Now remember, the dividend growth model comes from using the general formula for calculating returns in a period. I suggested to you that we could make some assumptions we can make assumptions that the first cash flow, C1, I remains constant, that's the discount rate, and G is a constant rate over time, and indefinitely returns to the firm grow at the rate G indefinitely. And then using that and those assumptions, so by saying the dividend growth model, that's what I'm telling you to do. I'm telling you to use this. And so you rearrange it for the I, where you work with determining what C1 would be and what G would be. And you already have the price. You're given the price the last year. So this would act like your P0, PV0. And all you need for this expression then, if you let this be the return to your stock, the expected return would be calculated by isolating I. All you need is the first cash flow, which would be the next dividend. And then you would need the price, which we have, and the growth rate. So the next dividend and the growth rate can be determined using historical dividends. So historical dividends, if they have a constant growth rate, if we assume that, then from 2005 to 2011, there are 6 periods of growth. So if I put the 5th year here and I grow it for 6 years to be 0.25, solve for G. G is this amount. Then I use G to estimate the next dividend, and I also use G in the formula. And I get this, which is similar, very similar to the 5% that I got. So that reinforces my decision to use the lower 5% rather than the 12%. So these are two different ways. One is using the dividend growth model with the assumption of constant growth. It's a tough assumption. I mean, it's a strong assumption, right? Constant growth forever. But anyways, that's what you get if you make that assumption. And I will refer to that as a DGM, or dividend growth model. So when I ask you to use it or apply it, that's what you do. So follow along here. Now, what's next? So now let's evaluate the project, remembering that we did find an IRR of 10% with the UAIR cash flows, right? If you look back at your notes, we found the IRR using the total project cash flows of 10.26%. And that does exceed the 5% figure, so we still invest. However, notice if we use the historical T-bill data and the historical market returns, then in particular the T-bill data is very different, then we would end up rejecting the project, because this 10% figure does not exceed 12.79 or 12.8%. So using IRR is really nice, you can see, because I don't have to recalculate anything. I mean, I could, and I can get this value. It's positive, so you should invest, but it's much easier just to work with the return and compare them. So this one doesn't change because it comes out of using just the cash flows. Now we compare this one to the proposed alternatives, and even it even exceeds the DGM, right? The required rate of return by the dividend growth model. So on all accounts, we should, well, except for this one, we should invest in, given all of our assumptions, we should invest in UAIR. We should invest in UAIR here. In the Bahamas project, I should be more specific. So with the information we've used so far and the assumptions, assuming that the beta is the same as UAIR's beta for the project. So the Bahamas project has the same beta. We can do all of this. But what if it doesn't? What if the beta of UAIR is, for this Bahamas line, is different? So what we're saying is, what if it's riskier? What if flying to the Bahamas is riskier than the other destinations? More volatile returns? And how would we find that out? Well, we'll look in the sector, right? In the tourism sector, and look at look at airlines that are flying to these different destinations and how they're doing with that. Oh, let's see. So what we have here, I've plotted with the security market line the risk-free of 1% and UAIR operations with a beta of 1.55 and the expected return of 5.27. This is calculated using the capital asset pricing model with the recent historical data for T-bills and the market return. And we see that UAIR is way up here. This is the UAIR operations, yeah. So that in fact, for this level of risk, this is your level of return you should invest, right? That's how you look at that. So we had several assumptions, and going back to that for a second, we also assumed, we assumed that the UAIR beta was the same as the Bahamas project beta. And we also assume that UAIR is all equity, but what if it's not? What if it also leverages? What if it also has borrowed from investors, has actual creditors in the company? How do we deal with this? Okay, I go through all this discussion here. Let me see. Just for terminology to be clear. If the firm is not all equity finance, but the firm assets include equity and debt, then the market value of assets of the firm should be the same as the equity plus the debt of the firm. I'm just going to go through some terminology right now. And again, you should have seen this before in 3106, but I'll just point through it. Sorry, I'm going to close the door. It's so loud. Okay, so we use S to refer to the market value of outstanding stock. So this is the total value of equity outstanding. So this is the total outstanding stock value. And we use RS to refer to the return on equity, otherwise called the cost of equity. So this is what we've been estimating using the capital asset pricing model. And this is the associated risk measured as the beta, and we relate those two through the CAPM. B represents the total outstanding debt. Okay, so this is how much, what is the value of outstanding bonds. And this is the return to bondholders, represents the return of their bond, and you see that as the yield, right, to maturity on debt. And the beta is the associated through the CAPM, it's the associated risk. We use V to be the market value of assets of the firm, equity plus debt. And use the notation R of assets to denote the return to the average investor in a firm with leverage or debt. And this is the associated risk, also related to the return through the capital asset pricing model. Okay, so these are connected to each other independently. So RS to RB, RB to beta B, what did I say? RS to beta S, RB to beta V, and R assets to beta assets. And I could draw them all on a security market line. They should all fall in the line. So in terms of what's going on, investors could be either shareholders, bondholders, or average investors. And I'm going to refer to average investors as individuals who are partially invested in stock and partially in bonds, but the shares are going to be equivalent to those shares that the firm is invested in stock or debt. Okay, so notice I use S over S plus B. This is 100% for shareholders. That's their weight. This would be the weight associated with being a shareholder in this firm if it's all equity. An all debt firm, this would be 100%. But for the average investor in a firm that has part equity and part debt, then their ratios in terms of how much they've invested, what portion they represent as shareholders and what portion as bondholders, is going to be equivalent to the firm's outstanding debt or equity ratios. So and now what I'm going to talk about is I'm going to talk about what's called the weighted average cost of capital, because I think you guys follow. If the firm is all equity, we've already dealt with that situation. If the firm has debt, we have to think about the average investor in the firm and their perspective, but we also have to think of the firm's perspective. It is the case that the required rate of return of the average investor in the levered firm should equal the cost of capital in the levered firm. In other words, what the firm pays out to the average investor happens to be the required rate of return of the average investor. Okay, so cost of capital is the opportunity cost. This is what they have to pay out for investors. Who are part shareholder and part bondholder. So this is a very important realization, that the perspective of the firm is matched to the perspective of the average investor in the firm. So what comes out of that is that if we want to determine what the return to an investor in the firm is, remember, all we've been doing for the last few weeks is trying to determine the required rate of return, the appropriate risk-adjusted rate of return. Now that we have included bondholders, the firm has to consider how that offsets the required rate of return, or the cost of capital. So what they do is they take the returns and they average them, except for this term. I'm going to talk about this in a moment. But they're going to conduct a weighted average of the return to shareholders and the return to bondholders to figure out the return to the average investor in the firm, that we're going to call the weighted average cost of capital. Now, where is this coming from? What is this term? Does this term make the WACC higher or smaller? What does this term achieve? So this is a weighted average. I've just put the notation here so you can realize this is a weighted average of expected returns. This one makes sense, that I'm going to be part shareholder, or the average investor in the firm will be part shareholder and part bondholder. What is this? I've referred to it as the after-tax cost of debt, because from the perspective of the firm, for every dollar, remember this is for every dollar, right? These are returns. This is for every dollar invested by bondholders, because, and this is the information you need to understand this, because debt payments to bondholders are tax deductible, this reduces the cost of debt. This is going to be this is going to make this amount smaller, right? Because corporate taxes are always between 0 and 1. So this is a fraction less than 1. So this will be smaller than if this didn't exist. So what's happening is that the firm has results in, due to the tax deductibility of interest payments to bondholders, that reduces, there's an effective cost savings of using debt, and so that reduces the cost to debt holders and the cost of capital as a result. Okay, so I made a note here. The firm pays bondholders interest payments for RB for every dollar invested. However, the firm also incurs tax savings for every dollar invested. So the cash outflow of the firm to its bondholders, and the cash inflow to bondholders of the firm for each dollar invested will be this amount. So I'm going to offset the payment to bondholders by the tax savings, and that's where that term comes from. All right, so this is WACC, which you must have seen before, and I've just included common stock and debt. And then we do an exercise. Oh, sorry, did I have to go down? So this is to point out to you that in terms of the beta of assets, so just looking at the risk, it's also a weighted beta. And be careful that this beta is always considered after tax, okay? Or you won't do this correctly. So this after-tax beta could be calculated using the CAPM and this return, the WACC, okay? Oh, sorry, not the WACC. This return here, RB1 minus TC. So that can be calculated. Okay, so you'd have to use that term RB1 minus TC in the CAPM. And then what do we say here? So what I want to show you is if the beta of debt is small. Now debt is less risk. Okay, let's talk about that for a moment. It's less risky to be a bondholder in a firm than it is to be a stockholder, because bondholders have a guarantee written into their certificate of indenture. They have a guarantee of getting a certain return through coupons or the time of maturity of the bond. Stockholders, on the other hand, have no promise, okay? The common stockholders. So we expect the beta V to be close to zero, small. If that's true, let's just let it be zero and see what this tells us. If we let it be zero or close to zero, relatively really close to zero, then it's apparent that the beta of equity will exceed the beta of assets. You can see that. So this is a weighted average, and if this one is small and this is less than 1, this weight, then it's true that the beta of equity will exceed the beta of assets. So in another way, it's a weighted average. It's smaller than the beta S will be larger, so it'll be a compromise between the two. Beta of equity is higher. So the beta assets is somewhere in between those two if you think of the security market line. So the example, finally, we have an example. You should practice making these calculations. Okay, I'm not going to do that. You make these calculations. Here we have, actually we should just do this one because the numbers are all here, but we should do this together. So this is the return to equity computed with, that's just the one that we had before, is it not? And then this is with the information provided about the debt issued by the Bahamas, or sorry, by UAIR for the Bahamas. No, this is just UAIR in general, sorry. So we're just including UAIR information. So UAIR became a, not all equity, but a leveraged firm, and its debt was issued at 6.04% yield to maturity. The tax rate is 40%, and the amount invested makes it so that it's 53% stock holders and 47% bondholder investment. Now, when you calculate the new R using the results of the CAPM for required rate of return for equity, you get a smaller number. Okay, so this went down. That's the main thing. Of course, it goes down because it is what is the word I want to use? It is tempered, or it is, anyway, it's brought down by this being smaller, okay? Because it's a weighted average with a smaller number. Well, that's not even smaller, but this is together a smaller number. So the after-tax cost of debt. So do you guys want me to calculate any of this? You're so quiet. So like this is 0.0. So all this information is provided in the case. Let's look at the case for a moment. So you see, this was the second part of the case, and you were given information about okay, so here's the information on bonds. This is document 5.8. So 6.04% annual effective yield to maturity. Okay, so that was the information on the bonds. And that's where I got that from. The information on the equity and debt is given as percentages here in the question. Okay. So all these numbers were given to you. You didn't have to calculate them. You just have to combine them. This is document 5.8. So what we've done so far is we calculated the CAPM using recent historical returns to get the historical market risk premium, and then I did it again with all of the data I had from back to 1928, and decided no, I'm going to stick with this one. And then I told you that, well, that's only if it's an all equity firm. And then I said, what if there's debt? And so we introduced the idea that there's debt issued with a rate of 6%. And so what you calculate here is the required rate of return, or the cost of capital for the firm. We call it the cost of capital, or the weighted average cost of capital. And this will be our discount rate, and it's just getting smaller because now you've included debt, and that just takes down the rate of return. And still we would accept the project, right? But what if the beta for Bahamas was different? What if the beta for Bahamas is different than the other UAR operations? What if we found that looking at other airlines that fly either exclusively to the Bahamas or partially, and when they began operations to the Bahamas, using that information, we estimate, I'm just giving this to you, but let's say it's estimated that the beta should be 5.5. This is 5 times riskier than investing in a market portfolio. So now what? What's going to happen? We've got to start again using the CAPM and solving using the same information that we did before, the recent historical market risk premium with the 1%, and look at what you get. The required rate of return with this kind of a beta for stock in the firm should be 16%. Went from 5% to 16%. Is this enough? Is the debt enough to dull the risk associated with that impacts the return associated with the stock issue? When you make this calculation, again, make all these calculations, you get 10.3. Is that still good enough? I don't think so. I think it was, if we go back, let me see, it was, the internal rate of return was 10.26 just for the cash flows. So that means we are no longer advised to invest in this project. Wait, let me think a second. If the IRR for the cash flows, right? Just for the cash flows. And the required rate of return is 10.33, we should not invest. Questions? Still no questions? What about my comment here? What do you have to say to my comment here? What is the effect of increasingly low T-bill rates on investment decisions? Treasury bills are all-time low right now. How does that affect investment decisions? Well, if you think about the way we calculate the required rate of return for projects, we're keeping this really low, and the lower that it is, it makes the expected return, the required rate of return, low, and so it's easier for investment, right? It's easier to argue. So this is how the government aims, or this is their approach to stimulating investment, really, because if they keep this is the understanding anyway, that they keep the T-bill rate low, that'll keep expectations for these investment projects low, and are lower, and there be more stimulus to an investment and hopefully productivity and growth. That's in theory. All right, so then I just made a last point here about what if you had a different class of stock? What if you had preferred stock? Well, it's no different. Preferred stock pays preferred stockholders before it pays common stockholders, and it's just a matter of finding out, incorporating them, their return and their ratio of outstanding stock value to the WACC. So if there's any other class of investors, you just include it in the expected return. So I gave you many exercises to practice this. It looks like most of you have seen stuff like this before, so I just think it's a matter of practice. Work with the notes that I gave you. Unless you have any questions. I know it's like I'm going fast, but you guys keep telling me you know this stuff, or some people have told me if you don't know this stuff, you guys have to speak out. So that's everything for the test. So everything you have is for the test. And I want to do new stuff now because we only have one more class. So any comments? Let's see what kind of questions I gave you. Oh yeah, these are all doable. Are there any questions that you guys have about any of the questions I gave? It's time to look at them and let me know if you need help. I gave you answers for everything. But that doesn't mean it's well explained. Well, in the context, I don't know if Diego, you're responding to my comment about the T-bills being low, but I was referring to government's objective of incentivizing business with low interest rates. That's what I was referring to. Okay. Any questions about any of these? This is your chance to ask me. You can't ask me after I give you the test. I give you all the answers, but again, it doesn't mean you understand, right? I'm just looking at anything. Tanya, you should have that document. I sent it to everybody. It's 512. Or is it 513? Let me see which one I opened. No, 515. It's document 515. You should have it. If you have the other documents, Tanya, you have to have it. Unless you might have deleted it by accident. I don't mind sending it again, but you should have it. Oh, you mean the question paper? No, the question paper you have because you asked me about it. Let me see what I sent you. Yeah, you should have it. You should have all these. So I gave you 5, 10, 11, 12, 13, 14, 15, 16, 17, and 18 on April 16. So 2 weeks ago. Check April 16. So let's see. Okay, so for this one, 518, I didn't give you a solution, did I? Okay, you guys have to speak to me about what you need. You guys fine? You don't need any help? You're good? You can do this one without me? Please let me know. I'm just waiting. Okay, Tanya, let's try this exercise. So let's work on okay, let's work first with the debt portion. So debt, there's a book value to the debt. You're told about 700, where is it? Wait. Yeah, 736 million book value, right? And keeping in mind okay, so everybody's okay with that? That's the information here. So 736 million is the book value. Preferred shares what's the book value? Preferred stock 1 million shares with book value $10 million. Sorry, $100 million. So 100 million. And then common stock. With a book value, oops, of this amount, and they have stock outstanding. Okay, we'll deal with that in a second. So common stock has a book value if a billion, right? 1,421 million. And now how many shares and bonds are there? Well, you're told that there's preferred shares are 1 million. The common shares are 44 million. And what about bonds? How many bonds are there? How many bonds are there? Okay, I'll leave that as a blank. You guys tell me what that is in a minute. All right, what next? What about market value? What's the market value? Tells you here that the price 834.18, so that's the market value. 834.18 per bond. What about the market value per share, preferred share? It's 85, right? And what about for common shares? Common stock. So it's less. It's going to be less because it's less valuable. So now, what would be the value outstanding of debt? You need to know how many bonds there are, right? To calculate this. So can somebody tell me how many bonds there are? All right, so this is the value of the book value of debt, remembering that the face value on debt is $1,000, right? So that makes it the case that there's 736,000 bonds outstanding, because 736,000 times $1,000 each is 736 million. Okay, so I just did book value divided by face value to get the number. All right, so we can figure out the ratios. Maybe not. We have them. Yeah, we have the price, right? We have the price outstanding and we have the number of them, which we needed. So now we can figure out the different ratios. So what's V? So V would be made up of B plus S preferred plus S common. Basically the denominator of all of those. So you get B from the market value times the number of bonds plus the market value times the number of shares for preferred and plus the price of common stock times the number of shares. Now you guys can practice this, but I'll give you the number so you can practice. This should be 2,106,956,480. That's the value of the firm. Now you need that to get the different ratios. So what's B, S, P, and S? I'm going to just put it here, maintaining my column. So B is equal to 736,000 bonds times 834 $2,222.18 per bond. And that makes $613,956, $480. SP, I'll circle it. It looks a little bit messy. SP is equal to $1 million shares times $85 per share which is 85 million. And common stock is equal to 44 million shares times $32 a share. Which is equal to $1,408,000,000. Now you need these for the ratios. You add these up to get this, and then you do the ratios of each. And what you need next, well, you have, for the WACC, you just need the returns, right? So what's the required rate of return on debt? So now I'll ask you to find me RB. You need RB1 minus TC, but first RB. And then you're going to need RSP and R, the regular common stock return. How will you get the return to debt? Anybody have a clue? You know, it looks huge and intimidating, but you have all the skills to do this. So just trust me when I say you have all the skills to do this. So zero in on the portion that's relevant. So the bond information is here. This area here. So what does it say? The interest on its debt is equal to $72 million per year with annual payments, and the debt is currently worth, okay, so that's the price, but what's this 72 million about? Those are the interest payments, right? What are the interest payments? The interest payments are the coupons. So overall, the coupons sum to 72 million. the book value is $736 million. So can you figure out the coupon rate? I'll take this down here. So for the coupon rate, remember the coupon rate, that's going to be that's what we want to figure out. You can calculate it if you know the total interest outstanding, 72 million, or sorry, the total interest paid, and divide by the book value, and you will get the coupon rate. So since the coupon rate is 0.09783, and these are annual coupons, the coupon itself in dollars is 9. Right, because I have to remind you what we do with the coupon. So to get the payment, right, we take the coupon rate times 1,000, which would give us the payment size of $97.83. Now what you do with that is you use the bond formula. The bond formula is that price, and you can use your calculator. And so you can ask your calculator to find the rate by telling it that there are 20 periods and then you tell it the price, and the interest rate is what you want, right? So we don't, that's the I. So just the notation looks a little different. I'm trying to tie it back to what you know. So this is what we want to find. And we tell that the present value, we'll put a negative on it, is 834. And then the payment that we receive would be 97.83 if I were a bondholder. And we put in that the face value is 1,000, and that's to be received. And then ask for the return what do you get? So the only thing that might have been sort of new, but now you should understand that, not exactly new, it's just an interpretation. The coupon rate can be computed by the interest payments divided by the book value. That's your coupon rate. And then this should be on your calculator, 12%. I'm going to wrap this up because I need to go to another meeting. And so that's return on debt. And then you're going to put that together with the tax rates in the WACC. The other rates that you need are the return. So let me see if I can divide these. This will be RB1 minus TC. No, I'll just put RB for now. So this is for RB. And I'm going to do RSP. And then you're going to have to put it all together, but I'll give you the answer. So how do we find the return to preferred shares? Well, we're told that the dividend is equal to $6, right? We're told that where are we told that? In the second paragraph, so I'll pull up, let me pull out what is relevant here. So from the equation, whoops, let me do that again. So from this statement here, I can drag out this sentence here. And that is how I know. So it's $6. So what do I know? That's all I know. Constant dividend of $6. So $6 forever. Well, we know how to figure out the price, right? We know that the present value, if we know the first cash flow, and divide by the interest rate, that we can find the price. But we already have the price. The price, we are told, is $85. So we know this is $85, and we know this is 6 forever. So we can find the expected return. Well, I'm not going to put expected there just because I've started to use this other notation. But that's what it is. This is like expected return to preferred shares. So now I can find it by doing this, inverting to find it. And so the return on preferred stock is a 7.0588237% return. Lots of steps, but you know how to do all of this. It's just, the whole test could just be this, because you get to use everything you know. One more time. All right, so let me circle. We have that, and all we need now is the common stock. So can somebody please, who's listening, tell me how you find the common stock return? You go into the question paper. Go into the question and find, what does it say about common stock? It says paid a dividend. No, that's not it. The common dividend is expected to grow at 5% per year. Common shares paid a dividend of $4. Okay, that's it there. So all this information I can use that to calculate the common stock return. Oh, I didn't put a C, just an RS. So what do? I find it just the way I would find when I first started learning about finding prices, right? Price is equal to, if it's constant growth rate, I just need the dividend, or C1, over I minus G. But I've been told the price, I've been told the dividend, and I've been told the growth. So what I really want, this is the dividend growth model at work, I want I equals C1 over price plus G. That's what I have to fill in. Now the first cash flow will be, since the dividend paid this year was $4, next period it will be one period of growth, so it will be $4 times one period of growth, and the growth will be at 0.05 and the price is $32. So that's how I find RS. And when you figure that out, that is equal to 18%, 18.125%. Then you put those all together as a weighted average, and your final answer when you do it, and you guys can check, the WACC is 14.1459024%. And that's your final answer. So you can review that. I need to go. Only a few of you are left on here. And I hope the students can watch this. I will send the test at 6. I will send the test at 6 o'clock, and it should be back to me by 3 o'clock. And please let me know if you have any questions, clarification. I'll help you with that. But I have to go. So let's keep in touch. I will email you in a few hours, and then if you have any questions, I will be available today, tomorrow, okay? And anything to clarify, I'm here for you. You can text me, is easiest. Okay, so I'm going to say bye because I got to go into another meeting. Bye for now. Have a nice weekend.